Welcome to the Kimberlite webinar to take a comprehensive look at the cementing liner hangers and wellheads market. My name is David Batt, President of Kimberlite Research, and I'm glad you can join us today. I'm accompanied by Andrew Thornton with Kimberlite Research, and together we'll take you through our 38th Kimberlite webinar hosted on behalf of the oil and gas operators who participate in our industry research. These webinars are provided as a professional courtesy and a thank you to the many oil and gas operators worldwide who participate in the Kimberlite industry surveys. In past webinars, we addressed the hydraulic fracturing, drilling, artificial lift markets, and most recently, we took a comprehensive look at the big four oilfield service providers, SLB, Halliburton, Baker, and Weatherford, and we also took a deep dive into the Permian Basin and Middle Eastern markets. Let us know if you or your colleagues would like access to one of these prior webinars. Just send us an email or a chat and we'll send you access to those prior webinars. Also know that we collaborate directly with oil and gas operators from around the world. So if you would like a customized presentation for your team, just reach out and let us know. Today, we'll be focusing on the cementing liner hangers and wellheads market, along with updates on technology trends and see how the competitive landscape and how the suppliers stack up in terms of performance and service quality across various geography and customer groups. Feel free to submit any questions that you'd like us to address during the webinar, and we'll do our best to address them. For those of you that are less familiar with Kimberlite Research, I will provide a brief background and then we can dive in. Kimberlite Research conducts about 3,000 one-on-one interviews with users of oilfield services globally. Over the years, we've interviewed over 19,000 users of oilfield services. From these one-on-one interviews of users of oilfield services, we produce a series of reports addressing formation evaluation, drilling, subsea, completion, production, and pipeline. Today, obviously, we're addressing cementing services, surface wellheads, liner hangers, and even subsea wellheads. The findings that we'll be sharing with you today are based on interviews with over 300 users of these services from 190 different E&P operators globally. The performance trends that we'll be sharing with you from 2017 through 23 are based on interviews of over 2,200 users and over 95,000 supplier performance ratings to formulate the analytics and trends that we'll be discussing with you today. The data set is rich and multidimensional. We'll be using this exhibit quite a bit today that we call the value map, where we cross-plot oilfield service company performance on the horizontal x-axis against pricing strategies or pricing competitiveness on the vertical y-axis. Any oilfield service provider that plots in the top right-hand quadrant is viewed as a premium provider, costs more but worth it. Any oilfield service company that plots in the bottom left is viewed as a discount provider, may not be industry-leading performance, but delivers good value, get what you pay for. Any oilfield service company provider that plots competitively in the bottom right-hand quadrant is competitively advantaged and is viewed in the eyes of the operators worldwide as delivering best overall value or strong value. And any oilfield service company in the top left, they're experiencing some value proposition challenges in the eyes of the end users and exhibit an opportunity to improve performance or maybe adjust their pricing strategies to get back down into the fair value fairway that you see running diagonally here. I'd like to thank the many oil and gas operators who participate in this research. I know myself, having worked at Chevron, when we would look for suppliers to use, we're really kind of looking for oilfield service company suppliers who have the technologies and capabilities to meet the needs of our projects. When I was at Chevron, looking for suppliers that can perform on par or better than industry average and even consistently. And so with that, we'll dive in and feel free to ask questions as we go along. Andrew, to get us started, what can you tell us about the markets?
Yeah, thanks, David. So let's just get kicked off here with expectations around overall activity. We're anticipating a strong market in 2024. There's been a lot of news recently, just from Saudi Aramco yesterday or Saudi Arabia. Also, we had LNG conversations last week. But broadly speaking, all of that is a lot of conversation, which will have an impact maybe further down the line. But in the short term, we don't see a material impact to overall activity. We're anticipating growth of about 5% on a worldwide basis for drilling. US flat, essentially, maybe slightly down. The growth continues international offshore. If you'd ask me what's the potential impact of that Saudi Arabia announcement yesterday? I mean, it may move that by a 0.1, 0.2%,
Right.
but materially not going to have a significant impact. The thing there we'll talk to later is
The
the
projects,
signal.
the projects that are in the pipeline are in the pipeline.
The projects are in the pipeline or in the pipeline. If it hasn't reached FID yet, then
Right.
that's a conversation point. But outside of that, it's still going to see some significant activity growth. And everyone has to remember that, Saudi's announced it's not going to grow to 13 million barrels per day of maximum sustained capacity. Its current maximum sustained capacity is 12, and it's pumping about 9. So it's still got a decent amount of headroom. When we look at this trended over time, this is our oil field sentiment index. Essentially, anything over 50 would mean expansion. Anything below 50 would signal contraction. You can see that drilling expenditures are anticipated to increase next year, but we're rolling over in North America, still anticipated to grow slightly with pricing and some activity, but really international land and offshore is where the majority of the growth is going to occur. And if I'm an oil field operator, I do need to be cognizant of the fact, although my market, maybe if I'm in North America, might be a little bit lower, there's still a call on service companies internationally, and that's going to have an impact on my supply chain. Looking at North America, just to kind of talk about some of the growth that we've seen over the last few years, you can see 2021 near 30% growth in terms of activity. 30 to 40% growth in 2022, and really we're now moderating at a reasonably flat level in terms of overall US drilling activity. Now, I think one thing to always bear in mind, sometimes we can look at numbers going down or rig counts going down or flattening. The demand for oil and gas is strong. It remains robust. If we look at all of the major data agencies, EIA, IEA, OPEC, every single one of them is projecting demand to increase. We'll see what the Fed does later today, but the US economy looks to be a little bit stronger than most people thought it would be 18 months ago. China is a little bit of a concern, but overall, demand for oil and gas just keeps on growing. And then when we look at the balance, which is what I'm always trying to understand, is okay, well, demand continues to grow. Supply is equally growing. If it's in the red down here, it's showing that, that demand is outstripping supply. If it's above the line, you can see the vast majority of the months we've seen, supply has outstripped demand to create a relatively well-supplied market, relatively balanced. Where is that supply coming from? This is an important graphic because, look, you can see the growth is anticipated to come from the US, but I just said the rig count's down, so just hold that thought for a second. Canada, Brazil, Guyana is really in that other bucket. And you can see that OPEC is actually down in terms of what it's adding. Just so everyone on the call is aware to the extent to which OPEC is essentially holding back production, this is non-OPEC production in the dark blue line.
It's growing. It's
growing. You see 20, 21, 22, and then we break out the quarters in 23. Here's OPEC, where it was growing as well, and that production has essentially, come off as they've had those announcements. So they're curtailing and keeping oil off the market. How are they able to do that with demand increasing and all of that activity? Well, here's the rig count in North America. We're anticipating that to be down 4% year over year. We're hitting about 593 right now to 600. Maybe we see some growth in the back half of 2024. But really what I want to show everyone is this graphic here. Here's a rig count going all the way back to the 1980s, way before I came into oil field, to be quite frank there, David. I know you were around at the time.
Thank you for that.
That's no problem. Here's production. And look at the extent to which it continues to increase, despite the fact that rig count is actually on a downward trajectory overall, or flattening off. Which essentially tells me that we continue to be producing more with less. We're seeing efficiencies, we're seeing productivity. And really the signals we're seeing from the market is don't get over your skis, steady as it goes. OPEC, Saudi's announcements is that the world does right now seem reasonably well supplied, at least in the short term.
Well, if I interpret what you're saying here is the supply growth is currently outstripping demand growth.
It is to
But demand's growing.
Demand's growing.
So we have this short-term period where OPEC's throttling back their production.
Yep.
To try to balance the market and
Correct.
stabilize the pricing.
Yes, you've got volumes coming in from Brazil, from Guyana. That's baked in. I think US surprise to the upside for the second half of 2023. There's a few tentative signs that it's starting to roll over, but we'll see. Never count out North America. That would be my general rule.
Okay.
Every one time someone says that's it, this North America's peaked, it goes and hits a new record. So yeah, right now supply and demand well balanced, but probably a bit too much supply on the market.
Okay.
So overall healthy.
So long-term macro looks good for both oil companies and operators, oilfield service providers, but the near term, there's a little bit of volatility and uncertainty.
Exactly.
Right. Okay.
Exactly.
Gotcha. Very good.
So, I mean, that sums up the broader market, David. But before we dive into the competitive landscape for wellhead cementing and line hangers, can you provide a few updates on some hot button topics? So like ESG, digital, and new energy investments, and maybe also some conversations around pricing and expectations there.
Sure, be glad to. When we take a look at ESG and digital, and we ask a lot of questions across the swath of the interviews that we do, we find that ESG sentiment remains high internationally and offshore, with about 75 to 80% of international and offshore operators planning to increase their ESG expenditures going into 2024, whereas in North America land, it's basically flat. And so when you take a look at the trend, you see how North America land ESG sentiment's beginning to roll over and get closer to neutrality near that 50 marker, whereas internationally we still see growth. And this also correlates with the activity.
I was going to say, it's interesting to see how that trends with the oil and gas activity at the same time.
But most of the ESG spending is around emissions monitoring, reduction of flaring. In North America land, a lot of the regulations from the Inflation Reduction Act that reduced inflation. But beginning around February of 25, greenfield projects become under some of these emissions monitoring regulations. And so Schlumberger or SLB still viewed in the eyes of the oil and gas operators as the supplier that's best able to help them meet their ESG objectives. And when we take a look at new energy investments and focus on the right-hand part of this graph, 21, 22, 23, you're starting to see some rolling over from the responses from the oil and gas operators globally about their plans to invest in carbon capture beginning to decline, geothermal starting to decline, hydrogen and wind staying relatively stable still. And so you're starting to see some pragmatic realization, if you will, about how long it will take for an energy transition and how fast you can implement projects. But a few things that we track digitally, such as the use of AI and machine learning, we find that about a third or more of the oil and gas operators globally find that the use of AI and ML really has some positive potential benefits, particularly around production optimization. As you pointed out, we're able to produce more with less, and they're using advanced algorithms to try to optimize the artificial lift systems. But also drilling optimization is viewed as a big beneficiary of using these algorithms and AI. And remote operations continues to be viewed quite favorably by 40+% of the operators in terms of being able to allow the oil and gas operators to make better business decisions and to operate more efficiently, drill more efficiently and operate more efficiently, which saves time, which is money. When you go offshore, a lot of the operators see disproportionately some benefit with having fewer personnel at the well site. You have limited space, or even internationally.
And people out the line of fire.
Exactly. For pricing, as you pointed out, internationally and offshore, activity is still relatively high. You mentioned that supply chains are still relatively tight for qualified personnel and equipment. And regardless if we're looking at drilling services, formation evaluation, or cementing services, internationally and offshore, we still see prices escalating or planning to increase 5, 6, 7, 8, 9% internationally and offshore. When you move to North America, you see some softening in North America, low single digits for drilling services and hydraulic fracturing, but still holding relatively stable in formation evaluation and cementing services, and even for surface wellheads, and even for artificial lift. And what we're really finding here is, from an oil company's perspective, the opportunity for pricing concessions is not nearly as significant and meaningful as getting improvements in efficiency, drilling, completion,
Yep.
production efficiency, being able to achieve more with less and operate more crisply. And so that's really where we're finding the big benefits when we talk to the operators.
It's interesting. I mean, historically, when the rig count drops to the extent we've seen over the past 18 months, you'd normally have a flurry of letters asking for 10, 15, 20%
right.
plus discounts, but it doesn't seem to be occurring. And is that really a lot to do with the need for technology, efficiency, and to keep producing more and less? You can't expect someone to then at the same time take a 20% haircut.
A lot of these cost increases are sticky. Labor costs have gone up precipitously, and that's sticky. They're not coming down.
Nope.
Even though the rate of inflation growth is slowing down to the 2 to 3% level, it still went up 17% in the prior years.
Yeah.
And so, yes, you do see some secular changes in volatility, be it with steel or profit or things like that. By and large, a vast majority of these cost increases that the industry has absorbed and had to deal with over the last 2 or 3 years, they're still in place in many cases. And so, again, in talking to the oil and gas operators, what we find is a lot of interest in trying to figure out of how to improve efficiencies, recognizing that you can only decrease prices so much. But as you can see, the world is readily supplied with oil and gas. We're having to throttle back, waiting for demand to catch up. And activity levels are still at relatively low levels versus the historic highs of the 2000s, 10s, 12s, and 14s. So. But with that, Andrew, why don't we take a look at the wellhead market, and maybe you can share some thoughts about how the major surface wellhead suppliers stack up in terms of market or brand image.
Sure. No, absolutely. So here we go. So wellhead supply is seen as leader. So this is what we call a brand image, and here's SLB for surface wellheads. Now, anything to the right essentially means that your brand image propagates beyond your own customers. So you may not necessarily be purchasing a surface wellhead from SLB, but you view them as really strong for critical service applications, HPHD. This is a strong brand image for SLB, and one we see a lot, very well liked by customers and non-customers alike, but not necessarily seen as a low-cost provider. Moving to FTI or Technip FMC, they've equally got a strong brand image as well. They're well known for field service performance and aftermarket service, so those personnel competency components. But they're also seen as a bit of a lower cost provider as well, opposite to SLB essentially. Now here's Baker Hughes, and you can see that they've got some, what we call brand image deficits, where users and non-users alike would say, look, there's some areas that you may want to have a look into. They're sitting in a little bit of a no man's land right now because they're not necessarily seen as a lowest cost provider or cost more but worth it. So some areas that Baker will want to look into essentially. Now, that was the kind of global market. Let's move to North America land where you've got a different supply base. Here's Cactus, some strengths in field service performance and aftermarket. Again, those personnel components. Not necessarily seen as a lower cost provider in the most recent survey. They have been historically. So they're sitting right there as a cost more but worth it now. Here's Streamflow. They are seen as providing strong value as a lower cost provider, but some brand image deficits. And then similar for Volt Pressure Control. But again, you see those brand image deficits, particularly on critical service applications and HVHD and technology, some areas that the company will want to look into.
They're holding pretty strong, though, on field service and value. That tends to be their, okay.
Exactly. And people should realize that if you're sitting right around this point here, around the center line, that means that your own customer base is pretty happy with that particular service. So they're comfortable with the field personnel, the service, and the lower cost provider. Here's Atlas, who we've just recently started to pick up in our service. Again, recognize the technology leaders right there, well liked by their own customers, but is seen as a bit of a lower cost provider. Now we'll kind of stack all of this up together.
Right.
This is on a global basis for wellheads. We can see, shouldn't come as a surprise, SLB stands out as a strong leader in critical service, in aftermarket. FTI also well liked. Not a lowest cost provider, but our cost more but worth it. And then when we roll over to North America land, we start to see a similar profile, but a different competitive mix in terms of where Cactus starts to pop up in terms of field service, where FTI stands up in technology, and then you've got Streamflow and Volt, as those, value brands essentially. So
Perfect.
overall, I mean, David, that's the kind of the brand image and how to see. But what does the competitive landscape look like for Wellheads? And then maybe could we take a look at the cementing market? And how do suppliers stack up in ties of operators based on customer reviews for performance?
Okay, well, if we take a look based on the user reviews from the oil and gas operators from around the world, what we find is in United States land, Cactus still stands tall as the market share leader, followed by SLB Cameron, who's gaining share, and then followed by just a whole host of other competitors. It's a very fragmented market with over 20 suppliers. When we move to Canada, Streamflow is still the market share leader and the incumbent, having operated in Canada locally there for over 50 years. But Great North, now owned by Drillquip, is starting to gain share at the expense of others that are out there. When we move internationally and when we move offshore, what we find is that SLB Cameron is really the market share leader, followed by Technip FMC.
Much higher consolidation, but still a fair few suppliers out there.
There are. When we take a look at the performance reviews, we see quite a bit of variance in the performance reviews of the various suppliers. So there's clearly no evidence based on the feedback from the oil and gas operators that all of these surface wellhead suppliers are performing at the same level. And when we look at the competitive landscape for U.S. land for surface wellheads, we see really an interesting dynamic forming here where a lot of these surface wellhead suppliers are starting to stack up in a very similar spatial positioning on the performance x-axis, which in aggregate, when you first look at it, would reveal that there's not much differentiation. But if we were to pierce into this just a little bit more deeply and go interactive, and this is our interactive dashboard, if we take a look at what's been happening really to Cactus, and if we take a look at Cactus over the years, from 2017 to 2023, you can see that they went from being materially advantaged in the market to starting to kind of move in and converge towards industry norm here. And if you overlay SLB Cameron, and let's just take off some of these years here, and let's just take a plot. From 2017 to 23, Cactus has gone from being significantly performance advantaged to starting to converge. And you can see that SLB Cameron has gone from having a value proposition that's becoming challenged to improving to where they're well within the fair value fairway and viewed as a premium-based supplier. And if you take a look at what's been happening on Cactus, and you look at the performance trends for Cactus, it's not that their customer review ratings that you see here are really declining. It's just that the industry average is improving to catch up. And so if you take a look at Cactus on equipment quality, they still have a distinctive edge. But if you look at field service, which has been their strength, their performance has historically been better than industry average, but now it's converged to be really in aggregate, not materially differentiated, while they've had competitors like SLB Cameron improving. And so if we take a look really quick at these suppliers, we do see some material variance. Cactus's competitive position varies by basin quite a bit. And so they're starting to show much greater dispersion than we've ever seen before. And in fact, even their user profile shows quite a bit of dispersion that we haven't noticed before. It's a great, more dispersion. And so, whereas if you take a look at SLB by basin, you can see that in many of these basins, the Permian Basin, the Marcellus, the Rockies, and Eagle Ford and Bakken, SLB Cameron has really strengthened up their performance. And so there's a lot behind what appears to be a converging market, but depending upon what basin you look in, you see quite a bit of variance. When you go into Canada, Streamflow is the market share leader, but is really struggling and challenged by Great North in differentiating their overall performance and value. When you move internationally for surface wellheads, SLB and Technip FMC are going at it toe to toe. Offshore, SLB is the premium provider, but again, you've got Technip FMC and Baker kind of viewed as the value-based alternatives, but you also have these other specialty suppliers, including Drillquip, that are very well positioned to participate in the growth in the offshore. When we move to subsea wellheads, it's really a three-way race between Baker Hughes, Drillquip, and TechnipFMC, with TechnipFMC really edging out the pack in terms of overall performance, but closely followed by Drillquip and then by Baker Hughes. When we move to cementing services, the oil and gas operators are asking the cementing service suppliers to continue to invest in improved equipment reliability, availability of cementing tools, but also in HPHT, because the investment growth internationally and offshore is including more and more exploration than it has in years past, and we're hitting some of these HPHT markets. The oil and gas operators, about 27 to 29% of international and offshore operators see value in automated cementing operations, with SLB and Halliburton as the leaders. And when we take a look at the competitive landscape for cementing services in U.S. land, it's true. Halliburton is the leader in terms of size, but you see SLB really beginning to improve in terms of their performance. You've got American and others coming on board. You've got Spinnaker, that's now part of RPC, coming on board. It is a heavily fragmented market over there. When we start to take a look at in the United States land market, if you go internationally, you've got SLB and Halliburton leading, and you've got offshore SLB and Halliburton leading with a much more consolidation. We do see quite a bit of performance variance. And when you go to the North American U.S. land market, you find that these specialty suppliers are really being viewed as delivering much better value than Halliburton. But what's interesting too is when you go, if we go back interactive, but we're going to have to change the data file here over to cementing here for a second. One of the biggest things that I've noticed in the U.S. land market, Halliburton's performance has been strong, but you're seeing some improvement here with respect to SLB. So if you come in here and you do now a head-to-head analysis of SLB, Halliburton versus SLB in the United States land in 2023, based on customer reviews, SLB's customer reviews are better than Halliburton's in many key performance areas. And amongst the common respondents that use both Halliburton and SLB to cement their wells in U.S. land, the users prefer SLB. Whereas if I just went back a few years, the advantage would have been more towards Halliburton. So we're definitely seeing a changing landscape for Halliburton in U.S. land as it relates to cementing services, where they're becoming more and more challenged. In Canada, Trican is outpacing Sandgel, but the specialty suppliers are viewed as delivering best value. When you move to international land for cementing services, you see a really interesting dynamic. Halliburton's the market share leader, but you see fully differentiated value between SLB, Halliburton, and Baker, and even some of the smaller specialty suppliers. But again, if I were to move this into international land and start to take a look at some of these performance trends, what we begin to find is we start to find on, let me turn on a few years to develop a trend, is that SLB's performance in the international land market is really accelerating. Okay. And when we do a head-to-head of Halliburton versus SLB in the international land market, just on 2023 alone, you see clear advantage in the eyes of the end users. And so even though Halliburton is the market share leader in the international land market for cementing services, Schlumberger is really going at them toe to toe. And even though we see them as being very similarly positioned in aggregate in the offshore market, if we do a head-to-head in the offshore market in 2023, and a head-to-head, it's pretty tight, but amongst the common respondents, the offshore operators that are using and have used Halliburton and SLB both, once they tried both, they tend to prefer SLB over Halliburton. So these, Halliburton's strong, but they're facing some significant challenges. When you get into cementing tools really quick, it's heavily fragmented with over 40 different suppliers. Weatherford and Halliburton are really the leaders in cementing tools. And we see Weatherford's leadership in U.S. land market with a strong market share, but Innovex has been growing and expanding in a heavily fragmented market. When you move to Canada, Weatherford's the leader. When you move internationally, you've got Halliburton, SLB, and Weatherford as the leaders in terms of size and market share. And the same when you move offshore. Competitively speaking, on the value maps in U.S. land, you can see how Innovex is well positioned with a host of specialty suppliers, and Weatherford and Halliburton is competitively disadvantaged and will probably continue to kind of lose their presence in the market to these other suppliers. Canada, Weatherford is dominant, coupled with a few of the local providers up there in Porto and Canadian. International land, you see nice
differentiated market.
And to wrap it up with offshore, you can see again where Weatherford is really well positioned to grow and expand as investment grows internationally and offshore for Weatherford. Well, Andrew, that kind of takes us to liner hangers if you would take us through it.
Yep, absolutely. Let's have a quick go through this one. So liner hangers, traditionally an area of strength for Baker Hughes, and that's demonstrated here by their market share sitting over a third of the market. Possibly some challenge, though, that they're starting to see from the likes of Halliburton and Weatherford, and even SLB to a lesser extent, along with some specialty providers in North America as they try to eat away into that share. When we look at this across different geographies, you can see that Baker leads across both North America, international land, and offshore, but the competitive landscape does change. Weatherford, a very strong provider of liner hangers in North America land market, as well as in the international land. You see Halliburton and SLB really start to grow. And then when we move to the offshore market, particularly with Halliburton with an expandable technology, that becomes a real challenge. But Baker leading overall. When it comes to performance, this is the global perspective. You can see here's Baker as the big liner hanger company. A slight challenge to its value proposition. They've expanded across all markets, right. So they've got to address a variety of different types of applications. What Halliburton and SLB have done very, very well is they've really honed in on the technology and the applications they want to work in, and they're executing, and that's a key component, right? It's consistent execution. Weatherford sitting out there a little bit behind in terms of performance, but well valued for what it offers. Now, North America land, an interesting value map. We don't see this too often. We did see it actually earlier in the cementing one, where at first glance, performance looks to be pretty much aligned between some of the major providers, with pricing competitiveness being the differentiation. But as you pointed out earlier, there are different components to this where Weatherford's probably a little bit stronger on the availability of its equipment. Baker may be a little bit stronger and responsive to needs. So depending on what your need is as an operator, you'll want to dig into the details to understand who can deliver for what I'm most looking for.
Sure.
Then we go to international land, relatively well-segmented market. SLB and Halliburton doing very well in terms of performance they're offering, significant in the case of SLB. Baker Hughes being challenged a little bit, with Weatherford also offering strong value. And then finally, when we move to the offshore market, you can see how that gets dominated by those two players, essentially, and a little differentiation between them, quite frankly, both vying very strongly. And probably what the market's looking for is a viable third player to start to eat away into that. Would that be Weatherford or SLB, or maybe even Drill Grip with some of its exposure in different markets as well? So that's the liner hanger market. David, to wrap things up, how do you see 2024 shaping up for the oil and gas industry? What upcoming market updates and webinars do we have, and any other additional bits and pieces for our audience?
Sure, absolutely. 24 is going to be an interesting year. Right now, as we talked about, supply is outstripping demand for now, but demand's going to pick back up. And so there's a lot of uncertainty in the market, but the overall macro is setting up pretty well long-term for both operators and service companies. So I think discipline and cautiousness is probably the key right now to make sure that we don't get overly committed until we kind of see where the supply disruptions could come from the geopolitical tensions and how the market will need to respond. We've had a lot of operator consolidation out there, and I would expect to see some consolidation continue on the oil field side as well. I would expect operators in 24 to continue to focus on drilling efficiencies and completion and production efficiencies as they continue to be very disciplined in the use of capital to achieve more with less. The tightness that you spoke of earlier, internationally and offshore, is real. So prices will still kind of boil up a little bit in 24. And so those are some things that we really just, will be monitoring for sure. In terms of new reports coming up, we're publishing this week updates on completion equipment and services, dealing with packers and sand control and permanent downhole monitoring, intelligent completions and plugs. We'll have later in Q1 an update on G&G software and seismic acquisition, as well as at the end of Q1 an update on seismic on subsea equipment and services. So the whole deep water segment's going through a multi-year growth cycle.
Interested to see what that shows us.
And then also going forward, we'll be making some changes on our format, moving from these live webinars to a podcast. So we invite all of you that are listening to tune in to YouTube and the other platforms by which we'll be sending out our podcast. If you want to stay updated, just please, log in to Kimberlite and sign up to follow us, and make sure that you subscribe to our website and to our YouTube channel. Links for both can be found on our Kimberlite website. So additionally, you can follow us on LinkedIn. And so we'll be moving to podcast, and we'll be providing more technical updates to the industry. We're starting to see all types of trends with the increase in use of dissolvable plugs. We're seeing an increase in use of downhole monitoring, particularly in the offshore sector. And so these are trends that we want to continue to track. We're seeing a lot of integration of sand control services, particularly internationally, less so in the Gulf of Mexico. So if you're an oil and gas operator and you're trying to benchmark the trends and things that you need to be aware of, please feel free to reach out. If you'd like to participate in any of our upcoming industry surveys, reach out to us as well. We'll be updating drilling services later this summer. And so for all the drilling engineers that are out there, maybe attending today's webinar, let us know if you're available to chat with us here in the next few months, and we'd love to collect your feedback. But with that, I think we should sign off.
I think so.
Thank you all for being with us today. Bye now.